Welcome back to the deep dive. So if you just checked the closing numbers for Friday, that's November 14th, 2025, you might have, walked away thinking the market had finally stabilized.
Right. I could see that. The S&P 500 managed a tiny gain.
And the Nasdaq, which was the epicenter of all that selling this week, it even rebounded by, 0.3%?
But if you scratch the surface, even a little, those headline numbers are deeply, deeply misleading. We saw a continuation of yesterday's panic before this dramatic, very micro-focused reversal.
A fractured market, then.
Completely fractured and divergent. It's signaling a major crisis of conviction that is, right now, splitting the indices straight down the middle.
And that contradiction is really the key here. The S&P, it managed to close at 6,746, but the Dow Jones tells the exact opposite story.
It absolutely does.
It fell for a second straight session, shed 300 points, and closed down 0.6%. So you've got tech names just clinging to life while the broader industrial market is signaling, deep pessimism.
And we think there are three powerful, interconnected narratives driving this split. You have a newly hawkish Fed, a crisis of confidence in tech valuations, and then this volatility multiplier from the recent data vacuum.
So our mission today is to show you why one part of the market was panicking, while the other was just desperately trying to hold the line.
Okay, let's unpack this.
We have to start with the macro anchor, because the biggest story this week, it wasn't really the trading, it was the seismic shift in interest rate expectations.
Absolutely. The selling we saw earlier in the week, it all started with the market abandoning a key assumption.
Which was?
That the Fed was, guaranteed to cut rates in December.
Okay, so when the market started to sell off, how quickly did those rate cut probabilities actually change? What was the real tipping point that broke that conviction?
You can see it clear as day using the CME Group's FedWatch tool. Last week, we were sitting on nearly a 70% probability of a December rate cut.
70%, that felt like a lock.
It did. But today, that probability has just collapsed. We're now talking about a 46% to 51% chance.
Wow. So it's a complete coin toss.
An absolute coin toss. And that is a violent repricing in just a matter of days.
And this wasn't random, right? This was a direct response to, a parade of Fed officials who seemed to show up this week to explicitly push back on the market's hopes.
That's exactly right. They decided they were done letting the market dictate policy. This chorus of hawks signaled that the FOMC, the rate-setting committee, is deeply divided about pivoting.
Who are the main voices?
Well, Atlanta Fed President Raphael Bostic was very clear. He said he sees, and I'm quoting here, little to no evidence to be sanguine about the forward trajectory of inflation.
And he wasn't alone. Bostic was backed up by Boston Fed President Susan Collins, who said it's likely appropriate to keep policy rates at the current level for some time.
Right, and then you had Cleveland Fed President Beth Hammack, who stated she doesn't support any further interest rate cuts.
It's a unified front.
It is, and this is critical. This is where that data vacuum comes into play.
From the shutdown.
Exactly. The Fed is operating after that record 43-day government shutdown, which left a huge data blind spot. We're missing crucial inflation reports, employment reports.
So they're flying blind.
They're flying blind. And with no fresh data to challenge their current hawkish mindset, they're defaulting to the safer, higher-for-longer stance. And that forces a massive repricing of all risk assets.
Okay, so to recap the first 2 points, the Fed is definitively not pivoting, and the lack of data basically lets them stay hawkish. But what does higher for longer really mean for all those expensive high-growth stocks?
Well, that brings us right to the valuation sickness in the tech sector.
Go on.
High interest rates are a direct assault on high valuation growth stocks. And the information technology sector is, it's ground zero.
Just how stretched are we talking?
Look at the valuation. The S&P 500 information technology sector is trading at a forward P/E ratio of 29.7.
And the historical average is?
The 10-year average is 22. So it's a huge 34% above that average.
Wow, and that valuation sickness, as you call it, that's why the Dow lost 300 points. It reflects that macro concern. But the Nasdaq, which is the most exposed, it saw a rebound, so why the split?
That rebound in the Nasdaq was purely tactical. It was dip buying, and very specifically targeting key mega-cap names like Tesla and NVIDIA that got crushed yesterday.
So not a widespread change in sentiment?
No, not at all. It was micro-focused buying pressure in just the biggest names.
Okay, and here's where it gets really interesting, I think. This sets up the central conflict we're all watching now, a bearish macro environment
The hawkish Fed,
versus a bullish micro narrative.
the AI revolution.
Right. The market today made a distinct tactical bet that NVIDIA's earnings report next week will be so powerful it will just completely override the Fed's pressure.
Which makes that report the single most important market event between now and the end of the year.
But that bet, it feels like it's resting on incredibly shaky ground when you look beneath the surface. Is this rally even real, or are we looking at a generals leading an empty armies situation?
That's the perfect way to put it.
We need to check the market's internal health, the troops following those generals. What's the most damning data point from today's action?
You have to look at the new 52-week highs versus the new lows on the Nasdaq composite.
Okay, what are the numbers?
The Nasdaq saw a mere 8 new highs.
8.
8 versus 186 new lows.
Wait, say that again? 8 highs versus 186 lows.
Exactly. This is not a healthy market. This is continuation of that deeply worrying trend we saw all week.
That is just a brutal internal picture. So what does that tell us about today's recovery? It means a tiny handful of mega-cap stocks provided all the momentum.
Right, well, the vast majority of companies are still in full retreat, suffering from rates and valuations.
And the fear gauge, the VIX, it supports this bearish reading, doesn't it?
It does. The VIX, the SIBO Volatility Index, it actually rose today, even as the S&P 500 finished, flat to green.
So the market moved up, but the fear index also moved up.
Yes. The VIX spiked over 6%, closing above 21. And a rising VIX alongside a rising or flat market is a classic negative divergence.
And what does that mean in simple terms?
It means the smart money is not buying this tactical rally. They are actively buying protection puts against a new leg down. The internals are screaming that this rebound is fragile and, frankly, untrustworthy.
And this internal weakness, it forces capital to rotate, right? This wasn't a sell everything panic?
No, it is a highly targeted sell what's vulnerable move. And the sector footprints, they tell the story of higher rates perfectly.
So where's the money going?
The worst performer this month has been Infotech, down 4.4% in November, purely due to rate sensitivity. That capital fled high PE growth, and it flowed directly into the best performer.
Let me guess, a defensive sector.
Healthcare. It's up 5.9% in November. It's the classic defensive rotation towards stable cash flows.
But even inside those sectors, the two biggest stock movers today prove that company-specific news still matters immensely.
It really does. Let's start with Micron. It completely defied the sell tech mandate. It soared.
Why? What was the catalyst?
Morgan Stanley labeled it a top pick, citing this huge bullish thesis centered on an AI-driven memory chip shortage.
A shortage?
Yeah, the analysts believe this shortage is going to drive new highs in earnings power that the market has, and this is the key part, not yet priced in. That specific, powerful story just neutralized the Fed noise for that stock.
And on the flip side, you have Bristol-Myers Squibb. It was the S&P 500's worst performer, falling 4%, despite being in that strong healthcare sector.
That was just a brutal pipeline failure. Bristol-Myers announced they were discontinuing the late-stage Phase 3 trial for a major blood thinner.
A Phase 3 failure is a huge deal.
It's a multi-billion-dollar setback, and it just crushes future earnings expectations. It shows you can't trade purely on sector themes. The fundamentals still override everything.
So if the stock action seems confusing, let's look beyond stocks for a minute. The cross-asset world seems to be providing a unified, crystal-clear story about the hawkish Fed.
The correlation is perfect. Just look at bonds. The 10-year Treasury yield rose again, closing at 4.14%.
That's the market's purest expression of the fading rate cut story, right?
It is. Investors are demanding higher compensation for holding long-duration U.S. debt.
And when U.S. yields go up, the U.S. dollar strengthens. We saw that today. It was trading around 99.1.
Right. The higher yields make the dollar more attractive to global capital. And that brings us to the casualty, gold.
Right. Gold was hammered.
It was. It fell 1.9% to close around $4,093 an ounce. And it's simple. Gold is non-yielding. When its biggest competitor, the 10-year Treasury, sees its yield surge and the dollar strengthens, that's toxic for bullion.
The only outlier today really was oil. WTI crude rallied between 1.5% and 2.4%. So what drove that move?
That was completely decoupled from the bearish macro fears. A strong rally like that suggests a specific, powerful supply-side catalyst.
And that was...
It was identified as a Russian port attack. It was powerful enough to just overwhelm any demand concerns related to rising rates.
So what does this all mean then? The cross-asset trade is a perfect mirror of the hawkish Fed trade, and the stock market is currently fighting this internal war where a few tactical bets are trying to ignore that massive macro force.
And next week is the ultimate showdown. We still have more Fed speak coming on Monday, including NY Fed President John Williams and Minneapolis Fed President Neil Kashkari.
And we'll also get the first piece of post-shutdown data with the NY Empire State Manufacturing Index.
But we know what the market is really waiting for.
The main event, NVIDIA's earnings report later in the week.
The market's fragile rally today was a huge bet. A bet that the micro power of the AI revolution can be strong enough to overpower the macro pressure of the Fed. But the market's internal health metrics, that rising VIX, the explosion of new lows, they're screaming that this bet is resting on very, very thin ice.
So the question you really need to follow heading into next week isn't just about what the Fed says, it's about composition. How long can 8 massive stocks hold up the major indices when an army of 186 stocks are signaling a full retreat by hitting new 52-week lows? That disparity, that is the tension that defines this market right now.